Hello and welcome to AI Market News by LM. Now before we jump in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. All right, let's dive into the core market dynamic for today, October 14th, 2025. Because, well, if we had to sum up the global mood right now, risk is running for the hills.
Hard. Yeah, it really is. Every major headline seems like, whether it's Beijing, Tokyo, DC, it's all feeding this big wave of risk aversion. It's just overriding everything else.
Even strong individual company news.
Exactly. Which you can see straight away if you look at U.S. futures. Based on the prepared resources, U.S. stock index futures are pointing, well, pretty significantly lower, reversing those gains we saw last week.
How much lower are we talking?
S&P 500 futures down over 1%. NASDAQ 100, that's leading the drop, nearly 1.5% lower. And Dow futures are also well in the red.
So it's clear, geopolitical fears just, well, it's winning today.
It's decisively trumping any local optimism, yeah.
And nothing captures that tension better, I think, than the whole AI valuation debate. You know, AI has been the engine for growth, especially tech, for the last year. But sentiment seems to be shifting.
Oh, dramatically. There was that recent Bank of America survey of global fund managers done early this month.
Right.
And it looks like a tipping point's been reached. 54% of them now think AI-related stocks are in a bubble state.
Wow, 54%. And that's a change.
It's a huge reversal from just the month before. Suggests managers are actively, cutting exposure because they're worried about these valuations.
Okay, but hang on. Is that 54% consensus maybe?
Mm-hmm.
Maybe a contrarian signal itself? And maybe more importantly, aren't the actual fundamentals kind of proving the valuation right, even if the multiple looks, well, stretched?
That is the core tension right there. That's what we need to watch. When we look at the pure valuation context, the NASDAQ 100, it surged 18% this year.
18%, yeah.
And that's pushed its forward price-to-earnings ratio near 28 times.
28. And the average?
Well, the 10-year average is 23, so that 5-point jump, that's what's setting off the bubble alarms. The fear that revenue growth just can't keep up.
Right. The multiple expansion gets ahead of itself.
Exactly.
Yet the actual foundation, the AI infrastructure,
yeah.
That seems rock solid. We're seeing genuine bright spots that kind of defy the skepticism. There are a couple of powerful data points showing demand for the tools of AI is just, well, exploding.
Absolutely. Take hardware. Samsung just reported its biggest quarterly operating profit in, over 3 years? 12.1 trillion Korean won.
And that beat forecasts.
Handily. The forecast was around 9.7 trillion won. That kind of beat doesn't happen unless there's just relentless, healthy demand for chips, memory, all the high-performance stuff powering AI globally.
Okay, so hardware strong.
Yeah.
What about software networking?
Same story there, really. Broadcom shares rallied pretty strongly after they announced a new high-profile deal with OpenAI.
So we've got this split then. Managers think it's a bubble.
Right.
But the companies actually building the AI foundation are reporting record profits.
Precisely. The debate isn't if AI is real, it's about who benefits and, maybe more importantly, how much they should be priced right now.
This whole internal market struggle, though, it's not just in equities, is it? It seems to be spilling over.
Oh yeah, it leads straight to the breakdown of another foundational idea in finance, the stability of government debt. If the AI story is so strong, why are investors seemingly running from U.S. treasuries?
Which brings us to this Microsoft anomaly you mentioned. This is, well, it's one of the most surprising signals we've seen in a while, isn't it?
It really is. The credit market is basically signaling deep skepticism about U.S. sovereign risk.
How so?
What's really fascinating is that Microsoft corporate bonds, the ones maturing in 2027, actually traded 1.9 basis points below the yield on equivalent U.S. Treasury bonds.
Below. That's extraordinary. Usually the U.S. government is the risk-free benchmark.
Always. Any corporation, even AAA-rated Microsoft, normally has to pay a premium above that treasury rate.
So if Microsoft bonds are trading cheaper than U.S. government bonds, what are investors saying?
They're essentially pricing Microsoft AAA-rated nearly half its revenue international as safer, more stable than the U.S. government itself.
Wow. Because of the shutdown risk, the debt issues.
Exactly. The political gridlock, the shutdown threat, debt ceiling fights. The market is effectively saying, We trust Microsoft's cash flows and global reach more than U.S. political stability right now.
That's a huge shift.
Yeah.
A really profound change in perceived stability.
It's not happening in a vacuum, right?
Yeah.
It reflects the broader geopolitical and domestic instability. Which leads us nicely into our next theme, political risk driving market fear.
Makes sense. Let's start with the U.S.-China situation. Trade war fears seem to be heating up again.
Intensifying, yeah. And that naturally dampens risk appetite everywhere. We saw China put sanctions on 5 U.S.-related entities of that South Korean shipbuilder Hanwha Ocean.
And the U.S. response?
Well, the administration says communication lines are open, but they've also threatened 100% additional tariffs on Chinese imports.
Following China's rare earth export controls.
Right. It's this tit-for-tat dynamic, very destabilizing for global supply chains and business planning, just maximum uncertainty.
But the global risk story isn't just U.S.-China these days. Japan saw massive instability too, didn't it?
Huge. Driven by that political turmoil after the LDP-Komeito ruling coalition suddenly dissolved.
And the market reaction was pretty dramatic.
Oh yeah, the Nikkei index. Steep single-day drop. Fell over 1,200 yen. Biggest drop since April, I think.
And this unwound something called the Takaichi trade. What was that?
So the Takaichi trade was basically a market position built on expecting continued aggressive fiscal stimulus, potentially under Takaichi Sana's leadership.
Okay.
So when the coalition collapsed, that sudden political chaos signaled, hey, maybe that era of easy fiscal policy is over, or at least very uncertain. So investors dumped assets that benefited from that expected stimulus.
Got it. And that political mess has knock-on effects for monetary policy too.
Absolutely. Market strategists are warning this makes an October rate hike by the Bank of Japan much less likely. Swap markets, they're pricing the probability below 10%.
So Japan's volatility isn't just equities, it's hitting the whole regional outlook, including the central bank.
Exactly.
So with risk aversion this high, where's the money flowing?
Straight into assets that, can't be easily manipulated by central banks or political gridlock.
Right.
The classic safe havens.
Gold and silver.
So remarkable new highs. Gold's nearing $4,200 an ounce. Silver surpassed $52.50 an ounce, a level we haven't seen since, the 1980s?
That's an astonishing display of fear, isn't it?
Extreme fear. When gold moves like that, it confirms investors aren't looking for returns. They're looking for pure capital preservation away from the traditional system.
Okay, now for the flip side. Energy. Usually, geopolitical fear boosts oil, but we got a different story from the IEA today.
Yeah, pretty fascinating counter-narrative. The International Energy Agency, in their monthly report, actually raised their forecast for oil oversupply in 2026.
Oversupply, how much?
Over 4 million barrels per day.
4 million barrels a day surplus? That sounds unprecedented.
Potentially, yeah. An unprecedented annual surplus. The forecast assumes OPEC, plus eventually restarts production, plus you've got rapid output growth from the Americas, US, Canada mainly.
So even with global recovery, that much supply keeps a lid on prices long term.
That's the implication. Unless geopolitical instability actually knocks out a huge chunk of global production, the structural ceiling for oil looks pretty low.
Okay. Shifting over to currency markets, all this global turmoil, how's it hitting the major pairs? Let's start with the yen.
Well, with this deep risk aversion, the yen saw buying pressure, as it often does. It strengthened into the high 151 yen range against the dollar. Finviz quoted it near 152.04 earlier.
And comments from officials played a role.
Yeah, Finance Minister Kato mentioned monitoring excessive currency volatility, which added a bit of fuel. But the yen's longer-term direction, still totally tied to that political outcome we discussed.
Right, so risk aversion pushes it stronger now.
But analysts are noting a future scenario. Maybe a PM like Tamaki favoring extreme fiscal expansion could actually lead to rapid depreciation later on. Massive debt issuance fears. It's really uncertain.
Okay, what about Europe? The euro against the dollar?
The euro's weaker against the dollar, trading near 1.1551 based on the inputs. We did get the German ZEW Economic Sentiment Index for October.
And how did that look?
It rose slightly to 39.3 from 37.3. So that reflects maybe some investor hope for a future recovery, perhaps driven by big infrastructure and defense spending plans.
There's a catch.
Always is, isn't there? The devil's in the details. That rise actually missed the forecast, which was higher at 41.1. And crucially, the current conditions part of the index, it unexpectedly got worse.
So hope for the future, but the present feels worse.
Exactly. Investors are betting on future stimulus, but they see the current economic situation in Germany facing real challenges. Underscores issues for the whole Eurozone engine.
Meanwhile, across the channel, the British pound took a hit.
Dropped to a 2-month low, yeah. Hit 1.3253 against the dollar temporarily. That followed some genuinely weak UK labor data.
What did the data show?
UK unemployment for August unexpectedly ticked up to 4.8%. That's the highest since May 2021. And private sector wage growth slowed more than expected, down to 4.4%.
So higher unemployment, cooling wages.
That combination instantly reinforced market bets for more rate cuts from the Bank of England. Bad news for the economy often means, good news for central bank easing hopes, hence the pound dropping.
Okay, let's pivot back to the U.S. central bank, the Fed.
Yeah.
What's the market thinking there? Rate cuts expected.
Based on the prepared resources, yes. Fed funds futures are implying a high probability the Fed cuts rates by 25 basis points at the next FOMC meeting.
And we're hearing from Fed officials today.
Lineup includes Fed Chair Powell at 12.20 p.m. ET, FOMC member Bowman earlier, and Waller and Collins later on. Lots of Fed speak.
But they're a complication.
A big one. The ongoing U.S. government shutdown. It's forcing the Fed to, fly blind to some extent.
Why does the shutdown make their job so hard?
Because key economic data, the really important stuff, like the monthly jobs report, the CPI inflation numbers, they get delayed or might even be inaccessible.
The data they rely on.
Exactly. The Fed needs that data to gauge the economy's temperature accurately and make policy decisions. Without timely inflation or labor figures, any move they make carries a higher risk of being wrong. It just adds to the market's fear.
And we can see that fear reflected in volatility measures.
Definitely. The VIX, the market's fear gauge, is noted above 21.83. That, combined with those extreme moves in gold and silver we talked about, it just confirms high-risk aversion is the dominant force today.
Even with those strong tech earnings underneath it all.
Right. The geopolitical fear is just overwhelming everything else for now.
So to understand where volatility might pop up next, we need to look ahead. What's on the economic calendar?
Okay, let's check the schedule using investing.com's calendar.
Today, the immediate focus is still heavily on central banks, right? Especially Powell's speech.
Yeah, Fed Chair Powell's keynote at 12.20 p.m. ET. Markets will be hanging on every word, looking for policy clues, especially with that data blackout ongoing.
And looking further out, particularly given the U.S.-China tensions.
Critically, we need to watch the inflation data coming out of China. That's tonight and early Wednesday, U.S. time.
CPI and PPI.
Exactly. Consumer Price Index and Producer Price Index. Those numbers give essential insight into the health and pricing power of the world's second largest economy. Big global impact.
Okay, so wrapping this all up, what's the big picture for us today?
We're in a really polarized market right now. Stability is just being dictated by these huge geopolitical headlines and political uncertainty. That's driving this sharp risk aversion.
And the key tension remains. Faith in the tech future versus lack of faith in the political present.
That sums it up pretty well. You see it in the strong Samsung and Broadcom numbers versus that U.S. sovereign risk discount and the crazy flight to gold. It feels like a fundamental repricing of trust is underway.
Which leads to a final thought to maybe mull over. If corporate debt, like Microsoft's, is now seen as safer than sovereign debt, does that signal the start of a real economic phase shift, where maybe global megacorporations are becoming, financially at least, the new nation states? Something to think about. Thanks for watching. Don't forget to like and subscribe.